Investing for Beginners in 2025. Introduction. High persuasion. If you've made it this far, it's because you're looking for something more than just controlling your finances. You want to achieve financial freedom, but you don't know where to start? The good news is that you are in the right place to take your first steps into the world of investing, and the best part is, with security, knowledge, and proven strategies. Most people are afraid to invest, thinking that a large amount of money is needed to begin. This is not true. With the right choices, you can start with small amounts, learn along the way, and, over time, make your money work for you. Here, I will show you exactly what to do to start investing in 2025, avoiding the most common mistakes beginners make. If you follow the right steps and stay disciplined, your results will be exponential over time. And it doesn't have to be hard. But attention, I'm not talking about get-rich-quick schemes or promises of instant wealth. What you'll learn here is how to make intelligent, sustainable investments to ensure a more peaceful future without falling into traps. So, before we begin, if you haven't subscribed to the channel yet, do it now so you won't miss any important content. Leave your like and share with friends who also want to start investing. Now, let's get straight to the point. Why you should start investing today. Time is a powerful factor when it comes to investment. Investing early means taking advantage of compound interest, which makes your money grow exponentially. Imagine putting $100 today and seeing it multiply over the next few years. Sounds hard to believe, but that's exactly how it works. The sooner you start investing, the faster your wealth will grow. 1. Time is your greatest ally. If you start investing at 20 years old, for example, and stay consistent over time, what seems like little can turn into a large sum in the future. The secret is to start today, regardless of the amount. You don't need a large sum of money to start, just take the first step. When you have time on your side, your money works more efficiently. The first thing you need to understand is that patience and consistency are key. The goal here isn't to get rich overnight. The focus is to create a passive income stream and secure your future. You need to be patient enough to allow your investments to grow. 2. Your money loses value when it's sitting around. Did you know that leaving your money in the bank is making you lose money? That's right. The value of your money decreases over time due to inflation. Inflation is the rise in the prices of goods and services over time, which makes your money's value fall. So, while you think you're saving, your money is actually losing purchasing power. The only way to prevent this is by making your money work for you. Investing is the only way to ensure that you're not affected by inflation while making your wealth grow. 3. Financial freedom starts now. Investing is not just a way to increase your income. It's also a way to ensure a more peaceful and worry-free future. Financial freedom is more than just having a lot of money. It's about having the power to make decisions without worrying about tomorrow. And that's only possible when you start investing smartly. It doesn't matter what your goal is. Travel more, start your own business, have a comfortable retirement, or simply live with fewer financial worries. The only way to achieve this is through investing. And the good news is that it's never been easier to start. Where to invest with little money in 2025? Now that you understand why investing is so important, the next question is, where to invest, especially when you have little money to start with? The good news is that there are several accessible options that require low initial investments and can bring great returns over time. 1. Real estate investment funds, REITs. One of the best options for those starting with little money is real estate investment funds, REITs. These funds are an excellent alternative for those who want to invest in real estate, but don't have the necessary funds to buy a property outright. REITs allow you to invest in properties collectively, with other people, and you earn a share of the rental income and property appreciation. You can start investing with amounts as low as $100 in some funds, and from that, you already have access to a portion of the property's returns. This is a fantastic way to get into real estate without needing large sums of money. 2. Stocks and ETFs. Investing in stocks might seem intimidating at first, but let me explain how to get started simply. The stock market is accessible to everyone. And the secret is to start slow and get it right. When you buy shares in a company, you become a part owner of that company and can make money from stock appreciation and dividends, a portion of the profits distributed by the company to shareholders. If you think buying stocks in large companies is complicated, the good news is that you can invest in ETFs, exchange-traded funds. ETFs are funds that bundle several stocks from different companies and are traded on the stock exchange, as if they were a single stock. They allow you to diversify your investments and reduce risk without needing to be an expert in picking individual stocks. 3. Treasury bonds. If you're looking for a more secure option, treasury bonds are an excellent alternative. This is an investment where you lend money to the government in exchange for interest. Treasury bonds are considered one of the safest investments in the country because they are backed by the federal government. You can start investing in treasury bonds with amounts as low as $30, which makes them accessible to almost everyone. It's a solid option for those looking for predictable returns, with the bonus of government-backed security. Conclusion of the first segment. By now, you've learned about the power of time and how to avoid losing money to inflation. You now also know where to invest even with little money: real estate investment funds, stocks and ETFs, and treasury bonds. What's left now is to put into practice everything you've learned. If you're enjoying this content, make sure to subscribe to the channel, leave a like, and share it with your friends. In the next videos, we'll dive deeper into strategies to boost your investments and achieve your financial goals. In the next segment, we'll discuss how to choose the best investments for your profile and avoid common mistakes beginners make. Stay tuned because you'll learn how to build your investment portfolio strategically and intelligently. Part 2. Investment strategies and mistakes to avoid. Understanding your profile as an investor. Before diving into any investment, it's crucial to understand your financial profile. Your risk tolerance and investment goals will shape your choices and help you build a strong, diversified portfolio. Knowing your profile is the foundation of successful investing. 1. What is your risk tolerance? Risk tolerance refers to how much risk you're willing to take with your money. Some people are comfortable with high-risk investments that could yield high returns, while others prefer more secure investments that offer slower but steadier growth. To determine your risk tolerance, ask yourself how much you are willing to lose in the short term in exchange for potential long-term gains. The higher your risk tolerance, the more likely you are to invest in volatile assets such as stocks or cryptocurrencies. On the other hand, if you prefer more stability, you may lean toward bonds or real estate. 2. Setting your financial goals. Understanding your goals is just as important as understanding your risk tolerance. Are you investing for a long-term goal, such as retirement, or a short-term goal, like buying a house or paying for a child's education? Your goals will help guide your investment strategy. If your goal is to retire in 20 years, you may want to invest in assets that provide long-term growth, such as stocks or real estate. If your goal is more immediate, like saving for a down payment on a house, you may prefer safer, more liquid investments, such as bonds or a savings account. Avoiding common investment mistakes. Even the most experienced investors make mistakes, but the good news is you can avoid these common pitfalls if you understand them. 1. Trying to time the market. One of the biggest mistakes beginners make is trying to time the market. This means buying and selling assets based on predictions about short-term price movements. While timing the market might seem like an easy way to make money, it's extremely difficult to do consistently. Instead of trying to predict market movements, focus on long-term investing. The market will fluctuate in the short term, but over time, it tends to rise. By investing consistently and holding on to your assets for the long term, you will likely see positive returns. 2. Failing to diversify your portfolio. Another mistake is failing to diversify your portfolio. Diversification means spreading your investments across different asset classes, stocks, bonds, real estate, etc., to reduce risk. If you invest all your money in one asset, such as a single stock, you expose yourself to significant risk. Diversifying helps protect your portfolio from downturns in any one market. A well-diversified portfolio may include a mix of stocks, bonds, real estate, and other assets. This strategy helps smooth out volatility and provides more consistent returns over time. 3. Letting emotions drive your investment decisions. Investing can be an emotional experience, especially during market volatility. However, letting emotions drive your investment decisions can be detrimental to your success. Fear and greed can cause you to buy and sell at the wrong times, which can hurt your long-term returns. Instead, Focus on a disciplined investment strategy. Stick to your plan and don't let short-term fluctuations in the market dictate your decisions. By remaining calm and patient, you'll be more likely to achieve your financial goals. Conclusion. By now, you understand the importance of investing, where to start even with little money, and the common mistakes you should avoid. You're on the right track to becoming a successful investor. Remember, the key to success is patience and consistency. Stick to your plan, invest regularly, and watch your money grow over time. And if you ever feel uncertain, don't hesitate to seek advice from experienced investors or financial advisors. In the next video, we'll explore advanced investment strategies and how to scale your investments for maximum returns.
Stay tuned.